Welcome to part 2 of our 2% Club strategy number 4, stay informed about exit and succession planning. So how do trends affect the value of your business and the value that you might get in a purchase and sale? Well, take for instance this chart on the Dow Jones Industrial Average from March of 2017 to March of 2026. As you can see, the value of businesses in the stock market go up and down over time. Some of it is predictable, some of it not. Well, in relation, your small business is a very small cap, high risk, volatile stock. Volatility means it's going up and down in value, even more dramatically than the stock market. So over time, your business will have a high value and a low value. Now, as valuation analysts, when we look at how trends work in valuation, we would look at the most recent historical trend, probably the most recent previous 3 years, and project the future earnings of the company. We're looking for a credible set of projections that help us understand what we firmly believe the cash flow will do in the next 3 years. And remember, it's important that your tax returns tell a credible story. We discussed that in strategy number 2. It's your financial projections and your future cash flows that you're actually selling. The credibility of these cash flows is contained in your historical trends, so the trends can be very important. This trend here, where we see a stable, steady increase, the bank will want to bank it, buyers will want to buy it, everyone will believe that this business is going to continue to improve and that the cash flow are going to stay strong. That's an ideal situation to sell a business in. However, if you get to the point where you need to sell your business and it doesn't substantiate the value you want, you may be tempted to say, I think our business is going to do this sort of an upward trend, where we're going to see substantial growth in the near future. Well, the banks won't cover it because they won't believe it. So you might consider doing something called a seller contract. Lots of people have sold their businesses on contract to the buyers. The buyers sometimes are unsophisticated enough or hopeful enough that they can create that trend, that they'll step into those shoes. But all of the horror stories that you've heard where business owners have gotten their business back after they sold it, it's because they sold it for a value that the historical trend wouldn't support. And when the new owner couldn't make good on the unrealistic projections, the cash flow wasn't available to service the debt that they owed to the seller for the purchase of the business, and so they default. The seller gets it back, and oftentimes in much worse shape than it was when they initially sold it. Obviously, this kind of unrealistic trend in selling your business is not a good thing. Now let's take a second look at another trend that can be very negative for you, and that's a downward trend. Even though we know business values go up and down over time, it's very difficult to sell your business coming off a downward trend. People will fear that, the same way they fear stocks in the stock market when the stocks are going down. People panic and want to get out. They don't want to touch it. When the stocks are going up, everybody feels good and they develop a lot of confidence that everything's going to continue to go that way. So a downward trend creates a lot of fear. The banks won't want to bank it, the buyers won't want to buy it, so most likely you'll have to sell it at a lower value, making your negotiating leverage that much lower. In the end, a good recent upward trend is one of the best things that you can have working for you when you go to sell your business. Now let's talk about what range of values you might expect to get for your business. Let's take a look at a car you want to sell. Everyone understands that a car really doesn't have one value. It has multiple values. And so, if you're going to sell a car to a family member, you might sell it for below market value. If you're going to sell it to a car dealer as a trade-in, you would expect to get a relatively low value. A lower value, certainly, than if you sold it yourself in a private sale to a third party. However, that very same car sold by a car dealer on a car lot would probably be the best option at getting the highest market value for that car. So, depending on who your buyer is, your business, your car would have several different values all at once. That's a range of values, and every business has a range of values. So now, when we look at businesses, you can see the 8 exit channels lined up here. Your business will have a range of values, again, depending on the buyer. That's why we say one of the 3 key questions that you need to answer when you go to exit a business is, to whom do I want to sell? Your buyer makes a difference in the value that you may get. Here we see liquidation on the low end of the scale and going public, selling in a publicly traded stock as being the greatest value. In the middle, we see sale to employee and management buyout. On the lower end, sale to third party and sale to a family member. Again, you must remember that for Main Street, most likely only the first 4 of the low end of the scale are available. That's why they get a 3 to 5 multiplier. And the other 4 on the higher end of the scale get a 6 to 10 multiplier. Those are middle market sale mechanisms, middle market buyers. So again, remember, business values are very volatile. They will go up and down. One piece of advice that we have for you is that you most likely can pick your value or you can pick your date, but most often you can't pick both. So when we suggest to you that there's 3 questions you have to answer: to whom do you want to sell, how much money do I need, and when do I want to sell? Most likely you only have control over a couple of those. If you pick your value, you can pick the value at a high point in time. But if you pick your date, you have no control over what that value will be. When we arrive at that date, it'll be outside your control, and it may be good and it may be bad. You may get lucky and you may not. Let's take a deep look at a case example of an actual 2% club member who went through a business sale around the time of the Great Recession in late 2007-2008. This member before the sale had a business value of $4.3 million. He had real estate worth $700,000. He had stocks and bonds of $1.5 million, of which the stocks were $1 million. So this business owner, who was 66 years old, had been in business for 30 years. He had earned between $100,000 and $200,000 for 26 of those years. He earned $1.1 million in 2008, and he lived on only $120,000 per year throughout that entire history. His risk-taking allocation was at 82%, while 18% was in financial security. Now, his business had only been worth $2 million in 2006, but due to what was going on in real estate, and as a construction-related company, he saw his earnings climb dramatically. And so his cash flows and his trend were on an upward swing. Everything was positive and everything looked great. And he knew that he needed $4 million out of this business in order to satisfy his personal financial security so he could move on to do something else. So when that value arrived, and at the time where his business became worth $4 million, he put it up for sale and was able to sell it very quickly. It was very important for him to pick his value and not his date, because 66% of his wealth was in his business. He hadn't yet achieved 2/3 of his wealth outside his business. Had he waited another 2 years because everything was going so well, it could have been a huge setback, because that business declined in value back down to $2 million in 2010. And so we see picking the value versus picking the date was a very important decision. Now, his asset allocation after he sold the business was $1 million of stocks, $3.4 million in bonds, and $1.5 million in real estate. That put his risk-taking at 18% and his financial security now at 82%. That's a complete reversal from when he owned the business. Now, if you don't understand the risk-taking versus financial security, please review strategy number 3, where we explain it in more detail. So as a summary, here are the exit planning tips that we have for you. 1. Remember that you can pick your value or you can pick your date. If you choose to focus on the date, then it's very important for you to have accomplished more than 2/3 of your wealth outside the business, because you really won't have much control over what value you receive. Focus on net proceeds. Compensation planning, taxation, and deal structure can make a huge difference in the net amount of money that you get out of the sale of your business. We've seen businesses sell for $1 million where the owner got $600,000, and we've seen other ones where the owner got $800,000. And the difference is simply how the deal is structured, compensation planning, taxation, etc. Remember that inside buyers will need good credit. If you're a Main Street business, your sale most likely will be financed through SBA financing, and good credit is absolutely essential to getting that financing. Main Street is different. The sales process, the value drivers, and the buyers are different. And for those reasons, all of those reasons, the range of values you can expect will be different. If you don't want to leave your business, which is okay, many business owners say, "I love my business, why would I want to leave?" That's fine, but you still need to focus on developing enough investments outside your business, enough for financial security that you're not dependent on that business. Because a lot of good businesses still fail for reasons that are completely beyond their control. We hope that you've enjoyed exit and succession planning. The next and final section of the 5 strategies on how to join the 2% Club is strategy number 5, protecting your wealth, the wealth management edge. Here, we'll teach you about how the successful 2% Club manage their money and show you how being the CEO of your family's personal wealth is a big responsibility. Share the ways in which you can manage that successfully and do it like other successful affluent families. We look forward to seeing you then.